The London stock market's record-breaking run has taken the FTSE 100 index to an all-time high in the last trading session of 2017. By the lunchtime close of the traditional half-session on the year's last date of trading, the blue-chip index of leading UK firms had jumped 64.89 points to 7,687.7. In 2016, the FTSE 100 jumped 14.4% as a weak pound boosted the earnings of blue-chip firms whose earnings are reported in dollars. This year the index is up a more modest 7.6% on its opening level at the start of 2017. A personal investor who put money into a FTSE 100 tracker fund at the start of this year will have seen a return of nearly 8% with a dividend payout yield of over 3% on top of that. Stone added, "Looking forward, I expect to see a further tightening of monetary policy in the United States with higher interest rates in 2018, and that to be mirrored with at least one further interest rate rise in the UK." On the currency markets, the pound was racing ahead after the US dollar took a downward turn, with sterling up 0.6% versus the greenback at 1.35. Miners have been among the FTSE's best-performing stocks this year, with Antofagasta up nearly 49% and Glencore up 41.6% year-to-date. Today, Rio Tinto and BHP Billiton lifted 84p to 3,942p and 23p to 1,464p respectively, as rising copper prices drove up demand. elsewhere, and MC Health has been the index's best performing stock, while a takeover has pushed WorldPay's shares 57.8% higher this year. House builders Persimmon and Berkeley Group both had a comeback year, recovering after seeing their shares plummet in the immediate aftermath of the UK's Brexit referendum in June 2016. BT's shares have struggled after accounting errors at its Italian business prompted it to cut its 2017 and 2018 outlook earlier in the year. Looking at 2018, Mr. Stone added, the political machinations of the Brexit negotiations may drive some volatility in the markets during 2018 and have an impact on sterling, albeit as we have seen in recent years a weak pound has a generally positive effect on the FTSE 100 index given its heavy weighting of companies with overseas revenues and earnings.